Imagine waking up in a world where your life savings could rot, be stolen, or vanish overnight. There are no bank accounts, no cards, no digital balances, only what you can carry, hide, or defend. To buy bread, you don't reach for money, you negotiate, you bargain, sometimes you plead. And to preserve wealth, you rely on secrecy, strength, or trust. This is how money worked before banks existed. In the earliest human societies, life revolved around survival, and exchange was simple but limited. What we now call barter governed daily life, the direct trade of goods and services. A farmer exchanged grain for tools, a hunter traded meat for clothing. Value was not fixed, it was fluid, shaped by immediate need. But this system carried a fundamental flaw. For any exchange to occur, both parties had to want exactly what the other offered at the same time, a problem known as the double coincidence of wants. Without that alignment, trade stalled. As communities expanded and needs diversified, barter became increasingly inefficient. To overcome this, societies began searching for something more stable, objects that could represent value even when direct exchange failed. Across different regions, people experimented with shells, beads, salt, livestock, and metals. In parts of Africa and Asia, cowrie shells circulated widely enough to function as currency. Yet these early forms of money were far from perfect. They were bulky, inconsistent, and vulnerable to imitation or sudden changes in supply. A decisive transformation came in the 7th century BCE in the Kingdom of Lydia, where rulers introduced standardized coins made from electrum, a natural alloy of gold and silver. For the first time, value was stamped into metal, verified by authority, and widely recognized. Coins simplified trade dramatically. They removed the need for constant negotiation and created a shared understanding of worth. But they also introduced a new dilemma: security. Carrying coins exposed individuals to theft. Burying them risked permanent loss. A fire or invasion could erase a lifetime of savings in an instant. In response, people turned to institutions already seen as sacred and secure: temples. In ancient Mesopotamia and Egypt, temples became trusted places of storage. Wealth could be deposited under the watch of priests, who issued records as proof. These early receipts could sometimes be transferred, allowing others to claim stored goods. It was not banking in the modern sense, but it marked a critical step toward it. At the same time, lending practices were evolving. Without formal institutions, borrowing was deeply personal. Loans came from neighbors, wealthy landowners, or merchants, often at steep and unpredictable interest rates. In Mesopotamia, agreements were inscribed on clay tablets, detailing amounts, terms, and deadlines. These were enforceable contracts, and failure to repay could bring severe consequences: loss of property, freedom, or even family members. Debt was not merely economic, it shaped lives and destinies. As trade expanded across continents, merchants developed something even more powerful than currency: trust-based networks. Along routes stretching from China to the Mediterranean, commerce relied not only on goods but on reputation. Transporting large sums of coins was dangerous, so merchants devised alternatives. These financial instruments, resembling bills of exchange, allowed wealth to move without physical transfer. A merchant could deposit funds in one location and retrieve their equivalent elsewhere through a trusted partner. This innovation was safer and more efficient, yet it rested entirely on trust. If a partner failed, if a document was lost, or if trust was broken, the wealth disappeared. There were no guarantees, no oversight, no protection. For most people, financial life was fragile. Wealth was physical, stored in goods, animals, or metal, and constantly at risk from theft, loss, or decay. In this world, money was not just a means of exchange, it was a gamble. Yet these early systems laid the foundation for the future. They introduced standardization, record-keeping, and trust, while exposing the limits of a world without institutions, where economies were slower, risks were higher, and credit was scarce. Over time, informal practices evolved into structured systems. Temples shaped early institutions, merchant networks expanded, and by Renaissance, Italy, the foundations of banking were firmly in place. Money had shifted from something you physically held to something you trusted. Today, it exists mostly as digital information, moving instantly across the world. This stability, however, is the result of a long and uncertain past. There was a time when every transaction required negotiation, every loan relied on trust, and every saving faced risk. From that fragile world emerged the financial systems we depend on today. Because money has never been just about value. It has always been about trust.